All right, so if we look at price action and we have it in our mind that we're bullish, the way I interpret price on a blank canvas, okay, in other words, if I'm looking at price and I'm ignoring the candlesticks, okay, I'm ignoring it. I don't trade that. I trade outside of the candlestick. So the methodology and the perception I have of price is not contained in a candle. It's outside of the candle. In other words, it's something that's really not there. And I'll explain that as we get to it. But this is the canvas I had in my mind for today's market activity. I seen this in my mind. And then what I do is I wait for price to create the scenarios that leads to a move from this price down here, which is the opening price. The idea is we want to see the opening price and a willingness to move away from that on the upside if we're bullish, obviously. But what's it being drawn to? A level of some old high, an old low, something that would draw the price to it in the form of a resistance level. The idea is we want to be able to see where price is trying to reach for. So where price is right now, that's the current market price, and where it should reach to, that's our range. Okay, inside that range, it can be further defined relative to the kill zone. So now we're going to incorporate the New York kill zone. This drill is only to be practiced in the New York session. You draw out your kill zone using the New York kill zone and waiting for specific things to unfold. What would that be? Well, if we're bullish, we're expecting movement away from that opening price. So between those two price points here, that's basically our dealing range. We're working within a finite range of price that has yet to unfold. So I'm seeing this in my mind before price trades there. I see it as it should reach up there, it should reach up there, and as price more or less is delivered all day long, I'm expecting it to get to that level and sweep above it, because what's above this level, the actual liquidity. Now, it can hit it one time or fall short of it and have a retracement of some sort, and you saw that today in my British pound versus US dollar trade. I didn't freak out when it started to pull away from the level. I knew it was going to go higher, and all it did was pull back down into a bullish order block. So in your mind, price action works off of this specific model here for this institutional order flow entry price drill. So if price were to meander and move up and create a scenario where it gave us a move like this, but if we're looking at it and we're expecting some bullishness and the underlying price move for the day so far was here, and we see this up here, my mind is, okay, we're inside of New York. We've had a run ahead of New York's open. So this whole price run here, it's probably going to be met with some retracement, and it's going to want to seek a measure of liquidity below current market price. And at the time, the current market price would be here, hypothetically. So inside of this low, and where price is now at this moment here, hypothetically, this is the known range, okay, because we had a nice little swing here, and it rolled up. My mind immediately goes inside of this range here, and I'm looking for inefficiency. I'm looking for periods of where there's one candle that just doesn't have any rebalancing. In other words, it's just one little single candle, and it can be as small as 3 or 2 pips, and that's going to be enough for me. And I'm going to anticipate price dropping down inside of the New York kill zone to fill in some measurable inefficiency. Now, it could be, like I said, as small as 2 or 3 pips, or as much as 10. So what you're going to do is you're going to see when price drops down into that inefficiency, you're going to look at the inefficiency and split it right in half. Right in half. Whatever that inefficiency is, okay, or fair value gap, whatever that is, divide it in half. That price in between the high and the low, whatever would create that fair value gap or that liquidity pool, when price creates that vacuum of only buy-side delivery and no sell-side delivery, that buy-side imbalance, sell-side inefficiency, we're going to split that right in half, and that's going to give our target price. So you split the range of the gap in half, that middle price, okay, that is exactly what you add your spread to. That's going to be what the level you want to see traded to for a limit order. You do not need to do that if you're going to do it as a market order. You'll simply wait for price to come down and touch what would be seen as that middle level. But the benefit of waiting for it to touch the middle point here is even if it just touches the middle point and starts to go up, many times you'll still be inside that fair value gap or that inefficiency. The ideal scenario is, and this is how I've grown accustomed to doing it, many times I nail the low, is as it touches that middle point of the fair value gap, by the time my brain sees it and I process it and I hit the button, the price may actually skip down to the lower end of the fair value gap and give me a better fill. When we look at price and we see this, what we're doing is saying, okay, I have not met the draw on liquidity. I am inside of a period of time where it should react. It should create a retracement and then a follow through on the upside. You know what you're looking for a timing condition. Okay, so you have time. You have a specific price level you're looking for. So now what do you have? You have an entry. It's a qualified entry. Why is it a qualified entry now? And this is for your notes. If you're not writing this stuff down, you're literally wasting your time. But a qualified entry is where you have a draw on liquidity. So that's where the market should go to. There's your bias. Your entry price point, okay, or your entry level, specific. It's finite. It's not ambiguous. It's not a supply and demand zone where, who the heck knows where you're going to get in there. What's the criteria for that? And you know when you're going to anticipate it happening. So you have a price, a time, and a target. So what do you do for a stop loss? How do you manage that risk? Well, you can open the stop up below this swing low here and just let it ride. But you need to be using your time efficiently and know what you're looking for. So now, with that in mind, when price hits that level, what are we doing at that moment? We're watching how much time takes place. You want to see when it hits it, you want to note the time. What time is it when it occurs? When it hits that price level, there's your time. You want to write that down. It's very, very important. You want to write that down. Then you want to sit and wait and see how much time it takes until it responds, in the sense that you wanted to see it go higher. Okay, great. Does it show a willingness to do so? And if it does, great. Once the high here gets taken out, your stop needs to come up to 50%. Now again, if you're not writing this down, you're blowing it. You want to take the range between the low and this low here. Once this high is taken out, okay, once this high right here is broken, you want to move the stop loss from this low to 50% of the range between here and here. Now why? Because price could one more time drop down. It can drop one more time into maybe the order block that exists here now, because there may be an order block that forms. We have a reaction in here. We can come back right back in here and go real deep in the order block, and the spread might get you. Your broker has the ability at this moment here to widen the spread and take you out. That's why sometimes when you all say, hey, my chart didn't go down to that low or that high. And many times if you're in a trade, you're going to see that it does go down there. It takes you out for that reason. By having our stop loss moved from this low to only 50%, it keeps us under the fair value gap. But we don't want to be prematurely stopped out. Once the high is taken out, then you reduce the risk. You do not jam it up to your entry or go 1 point above the entry. You don't want to do anything like that. You want to keep it away and underneath this whole condition. This is the condition that gave you the basis of wanting to go long. It's a fair value gap. Or liquidity void. It's an imbalance. So it was only buying there. Price comes down, gives us an opportunity to rebalance this little area in price action with sell side delivery. At points of entry that you want to have, and your brain will see the chart and say, okay, I see this opportunity. Here's where I think it's going to go to. I can see the draw on liquidity, because 90% of you, once you watch the videos, I talk about how to see where the liquidity pools are or where the market should go. And the perfect example is the equal highs and equal lows. You know what you're looking for now, an entry point. And what makes it institutional order flow is because there should be an immediate response to that, and they should not be wasting time before it takes off again to the upside, and it does. So now I've given you a reason to want to be a buyer in your demo trades, how to manage the stop, where the stop should be. Now, what happens if there's no swing low down here? What do you do there? You want to be below any down close candle. Like say this low here to this high here is all one consecutive price swing, and there's really no discernible breaks or retracements in that. Just simply find the biggest, boldest down close candle, and your stop needs to start underneath that, because that's going to many times be an order block. And then maybe this will retrace deeper. It may not respect this. It may trade down to the order block. Okay, and that means you can weather the trade and still have the condition that is the draw on liquidity over here and the entry here. We might get a little bit deeper retracement, but not get stopped out, and then it takes off. All right, so here's the price action for the British pound. Whenever there's a gap on Sunday, the normal action is if we gap down, we want to see a whiplash, which is price going back up, filling in the gap. This movement here is whiplash. This run up, filling in the gap, that's what I nicknamed whiplash. It opens down here, and boom, it jerks it right back against everyone thinking it's wanting to go lower, usually the retail club. At this moment, it becomes catapult. Catapult is where we sell short after the down opening gap is filled. What do we trade into? An order block. Price trades down into the order block, and here's the opening price. This long here is really a power 3. You have the open, we traded down below it, and rallied up. Now, if this would have been part of a move that was sustained on a daily chart that's been going higher, and it's been clear, which it hasn't been on the daily chart, let's just be clear about that, then I would have been buying down here. I would have been looking for that to happen. But because it's Monday, I did enough damage in my examples, I wasn't watching this. I didn't see it as a buy, but I did cover as it went down in there because it's the order block. It could have bounced up, and I thought it was going to fill in this gap here and then maybe give another sell-off in New York. That's full disclosure. Okay, that's what I was expecting initially. But we saw it tearing through, and then I said, look, when we see that gap, okay, if it's broken on the upside like it does here, well, wait a minute. Now we went up and filled it. We went down, but then we went back through and started moving away from it. That's very, very bullish. If we have a gap that is a gap down and we trade above it, that's extremely, extremely bullish. But I couldn't catch anything in here, so I simply waited for an inefficiency to open up. Inside of the New York kill zone, we see this one big candle run up here. Did this candle get to our draw on liquidity, which is the previous day's high or last Friday's high? No, it didn't. So I'm going to wait for price to drop back down into this inefficiency. I know that institutions are going to want to buy right in here because they know the liquidity resting above here. So IPTA will come down into that and allow those traders to get on board. Now notice what I'm doing. I'm buying as the market's dropping, even though it's at the high of the day. The condition is bullish because we had that gap traded above. It should have only went up and filled the gap here and then broke down and traded lower. It did, but we were unable to make a lower low here and go lower. It stopped it in its tracks, and then they put it on the other direction. Once the gap is taken out, that's significant. We want to be a buyer, but we don't want to chase price. Now, I could have went in here and bought right inside this down close candle. Right when this candle was right at the close, I could have bought right there. That's a close proximity entry. That is an institutional order flow drill. You could do that as well. It doesn't have to be the inefficiency. You can be buying close proximity down close candles inside of the candle and the unrealized objective, the draw on liquidity, which is over here. That would be the basis of your entry. And again, same premise. You want to use a stop below some swing low, or if it's a down close candle with no real distinguished break or retracement, you go below the order block or down close candle. You saw me use the fair value gap or liquidity void here. As it traded down into it, I nailed it. Went long hemmed around in here a little bit and waited. And then I said, okay, we're going to see it expand on the upside. And then popped up on this candle here. And I said in the video, this is going to be the last down close candle until it runs through Friday's high. There's only one down close candle. The way I did that and what made me know that is inside of this little consolidation of price action. Now, granted, this is like a bull flag. This bull flag had a lot of things going for it because we had the liquidity pool resting over here and the fact that it was not traded to, and it's extremely bullish because we took out the gap and traded above it. And we're inside of a New York kill zone. So relative to time and price, we have a retracement in an existing bullish condition and a target that has not yet been realized. So when price drops down, we're buying a down moving market. That's exactly what institutions and banks do because they have to buy large volume at opposing price movement. In other words, if we're buying, we need to be buying when price is dropping. If we're selling short, we need to be selling short when price is rallying higher. You have to do that. If you want your trades to turn around with the lowest point of drawdown, that's how you do it. It's scary because you don't know what you're doing because you haven't done these types of drills. But close proximity entries using the relative high in here on this down close candle. Once that candle closed and we opened up here, even when the price rallied up to this point right there, okay, right there, that's still a buy because you're inside of this down close candle. Later on, that down close candle could have been traded down into this void or fair value gap could have been just one piece of it, and it could have went down a little bit deeper and traded into the order block, and that still would have been fine. You're going to see examples of it happening like that when you do this. It doesn't mean you're wrong. It just means it's giving you experience by watching price with a specific criteria, a perspective on price that should be very clear to you. And you see what my trades look like. I'm getting in at ridiculous levels underneath old lows or at the lows, and I'm getting out above an old high or at the high. I learned how to do that by practicing just like this. Now, you don't want to do this drill once a liquidity pool has been taken here and we run out of time. Now, over time, when you work with an intraday price action like this, doing these drills, there is no difference between doing it on this 15-minute time frame and if this was all a daily chart. Think about that. Because price is fractal, and what I'm teaching is institutional order flow, this big run up here, retail's going to want to buy that. Well, they retrace. You're not going to buy that. You're going to do the same entry technique here, right in the middle of that fair value gap or liquidity void. You know that there should be buying in there. Hello, now you're a swing trader. Look how much of a move you would have captured if these were all daily ranges. Now you want to look at it another way is say this is a weekly chart. Say every one of these weekly or these candles represent a weekly range. Same thing here. You would drop down in here, you'd be buying, you'd have a stop down below the swing low or below an order block, and you would just let it go. And imagine the amount of pips this would be if, again, these were all weekly ranges. Huge amount of ranges. Now I got your gears turning, haven't I? So, if we can see the benefit of practicing with a logical protocol, a step-by-step looking for specific criteria, time, price, draw, and liquidity, we know what we're looking for, we know how to define our risk, there's no reason why you can't find your 25 to 30 pips a week now. Because every single day, it gives you one. See, I gave you the ideal scenario to look for close proximity entries and inefficiencies. Those two strategies are internal range liquidity entries. Internal range liquidity is the low here to this high here. So we're inside that range. It has not broken out to the upside of this range here. So any retracements down, you're buying internal range liquidity and targeting external range liquidity. That's the basis. Okay, so you're taking what institutions would see as a discount or a fair value price. They're going to buy that. The retail is going to be looking to sell short, but they want to buy it because they know if they buy it here and there's orders above this high here and above this high here and above these equal highs over here, that's where a larger liquidity pool would be resting. You can see that's where price ran up into and even further than that. So I can't stress it enough. There's opportunity for you to grow every single day if you use this. If you look at this and you practice it every single day, you're going to get good. There's no doubt about it. It's a default. It's going to happen because the market, 90% of you all know that if we are slightly bullish and there's an equal high to the left of us, you know where it's going to go. Now, the problem is you all want to know if it's going to go up there and then sell short. Why do you need to do that? If we have a range between here and this high here, this is just a single point pool of liquidity. A double high or double top, that's just another form of a liquidity pool. It's just two of them. But a single stop point right in here is enough for me. It's still a low resistance liquidity run, but it's not limited to that. You can use a single high, previous day's highs and lows. Remember, that's where the large institutions are going to have their liquidity at. So that's just one example in here. Here's another one. We have this little run up in here. So this candle's high to this candle's low. There is a inefficiency in there. Split it in half. As price hits it, you buy it right there. Boom. So you can actually see a little bit of a run in here. The market opens on this candle and drops down into the order block right there. That's that order block I mapped out as it happened in real time. And all it did was drop down into an order block, and I said, okay, now it's going to run up and blow out the Friday high, and then it did it. Okay, so we watched it actually on a 5-minute chart right in here. Hits the order block right there, and then runs through. I'm out of it here. It gets stopped out here, and then the secondary run up where it's all just really being driven by the central bank. They're really pricing it higher. And that little tiny little drop down here, there's the entry, and it has to be a little bit lower to get that fill because of the spread. So I'm right in there at the middle. That's what I hit it at. As it went through the middle of that, I hit it. Very, very, very little drawdown. I mean, that's beautiful. I bought the down close candle that made the low, that swing, and I sold it above the known liquidity pool. 15-minute time frame. Here, this is a market maker buy model. Consolidation. We left the consolidation. Retrace. Okay, that's a distribution. Redistribution, another level of redistribution. Smart money reversal. Low risk buy. Reaccumulation. Boom, cleared it out. So there's your market maker buy model. So again, that was another reason why I was comfortable buying over here, because I knew we were over here off of an area where we did some distribution. So it's going to reverse its roll over here and accumulate to the upside. And then there you go.